I wish you all a Merry Christmas. It's the last webinar here this year in this Trading Spotlight webinar series. And as you may have guessed, I'm today Santa Jens, and we'll present you something on the so-called Murrey Math and how to use it in regards to your price action and trading. So I think it's a very, very interesting concept. Yeah, we want to dig deeper into this topic. I can already say that there's an indicator called Murrey lines or Murrey Math lines. You can download for the MT4, MT5. It's not within the trading platform, so I'm the MT4, MT5. So if you want to have this indicator I present here, feel free to reach out to Admiral Markets directly. I think via an email. This is probably the best way, and then we can forward you this indicator, and you can use it within your trading station yourself. So, well, let's have a look here at today's agenda and the questions we want to tackle today. So, first question is, what is Murrey Math? The second one is, what are the Murrey Math lines? These are the key component here. And then the third, and this is probably the most interesting one when it comes to this topic here, is a step-by-step guide for, let me just have a look here at the chat box. It's a step-by-step guide or strategy, how you can use Murrey Math lines, one idea, how you can use it within your trading. And yeah, so that's it around the agenda. Here, this is me. I don't want to dig too deep into details around me. What I can assure you is you will find a link to an interview I did with Admiral Markets already in June, July, how I got started in trading. Feel free to click this link, read it, or check the chat box. I probably will also have it here within the webinar in the chat box. The most interesting thing probably is the fact that I'm located in Berlin, in Germany. And why is this of interest? Because Admiral Markets, the company, the broker who makes all this possible here within this Trading Spotlight series, they have offices around the globe, and also one here in Germany, in Berlin. It's something like 20 minutes or so from my office here. And let's dig a little into Admiral Markets here as a fully regulated broker with offices around the globe. So this means, especially from a customer support perspective, this is very, very interesting for many, because you can be sure that you have a service member from Admiral Markets taking care of your whatever issues you might have, problems you might have within your trading platform, or deposits within your trading account, withdrawals, whatever, in your respective language, in your native language. Also, on top of that, here in Germany, we refer to Admiral as the so-called DAX expert. So with highly competitive offering when it comes to DAX trading, with a 0.8 point spread during the main trading hours. What is probably even more interesting, especially for those trading short term. Okay, so just let me. I just hope that I can be seen fine, and that everyone can see my screen right now, because I can see here. Please check the projector that somehow between the lines I can read that there's probably an issue. So if this is the case, please let me know and write it here into the chat box if everything's fine, but also if there's an issue. Yeah, let's come back to the DAX and the DAX expert, Admiral Markets here in the German market. So usually we in Germany, among traders, professional traders, we also refer to Admiral as the so-called DAX expert with a very competitive offering. Admiral Prime, that was what I wanted to mention. Admiral Prime is also something which is of high interest, especially for short-term traders, because they have a 0.2 point spread with the commission you pay on top. So you have a tight spread, which makes it yeah, very interesting for short-term traders. But now let's dig into the topic of Murrey Math and give an idea of what this is. So first of all, here you can already see it in the first sentence. Murrey Math is based on observations being made by W.D. Gann in the first half of the 20th century. So who is this guy, this W.D. Gann? It's William Delbert Gann. In fact, he lived between 1878 till 1955. He was a mathematician, if I'm not mistaken, and he developed, as a trader, he developed a method which some of you probably have already heard, or you could probably have seen it when you try to display Fibonacci's, for example, within your chart. You will also see that there is Gann levels, respectively Gann angles, and so these are based on mathematical formulas he developed, respectively. Also, if I'm not mistaken, it's also to some extent, so mathematical formulas, so geometry, I mean, and then there's also some components from astronomy and astrology, I think, within it. So this alone makes it for especially someone like me, who is very, very quantitative in his trading, in fact, difficult. So I consider it with a grain of salt, let's say, what Gann delivered. Nevertheless, Murrey Math is derived from that, and the core element here is the price movement of any market will retrace in multiples here of 1/8, 2/8, also 1/4, and so on, up to 8/8 in this case. So, which already means we can draw the following conclusion: that Murrey Math divides price action, or prices in general, moves from high to low, or from low to high, depending on the direction, into 1/8 intervals in this case. So already something I just realized. Please don't be surprised that I'm not using the MetaTrader here within the webinar and show you the indicator under real trading conditions, but only snapshots I made. The reason for that is quite simple. So I fear that the quality of the webinar will massively drop when I open the MT4, respectively, in my case, the MT5, because of the resources here with my laptop. Funny enough, not given. So I definitely have to think about getting a new laptop. I thought that it's probably one which has enough resources and is fast enough and can handle lots of softwares I open and trading stations. But in this case, it's funny that the MT5 is taking so much resources, in fact, that I sometimes run into trouble when having it open during webinars. So I kept it closed. But I prepared some nice charts to illustrate the Murrey Math lines then here, so I can assure you that. So let's have a look here. We will refer to this as MML now, so Murrey Math lines, okay? And we already said this, that the Murrey Math lines here consist of 8 pivot points, which each line having a different meaning to the price action, in fact. So Murrey Math lines divide the price action into 8 important levels with 8/8, 4/8, and 0/8. So in fact, the high and the low having here the 8/8 and the 0/8, and then a 50% retracement, so half of that, with being the most significant pivots in this case. So you can already see, in fact, that there's a chance to derive some information from that. So it's not that this is something like the holy grail of price action or something. It's another concept I'd like to present to you. It's a concept which is very similar to pivot points. So something you probably may have seen, and there's also some other, well, how can I say that? Some adaptations being made over the years. So Camarilla pivots, for example. We have also Fibonacci pivots and all this. It at the end, it comes down to whether it suits your personality, whether it suits your trading. But I have to say that in general, it can be a very, very interesting concept under certain market conditions. And sometimes, in fact, when I write articles, respectively, especially research pieces, and I have some trouble to interpret the price action, respectively, to find levels which are of higher importance. I use concept like pivot points, for example, to have at least an orientation. And where does it all come down to? I use these lines, respectively, these levels, and especially if they make sense. So I'm not only using something like pivot points, but what I also do is I try to create so-called clusters. So, which means I'm sometimes also using, for example, Fibonacci's. And if a Fibonacci level, whatever it might be, let's say the 38.2% retracement or something, falls together with a significant pivot point, intraday pivot point of the day, we have already a region which could act as some kind of cluster. In addition to that, that's then what I present now is a little yes, it needs a deeper understanding of price action, but I'm also looking, and probably today it's a special day in this regard, and that's why I have to mention it. I also look at open interest when it comes to options, especially when we're looking at the DAX. So when looking at the DAX, I look at the open interest, which means that what levels are of interest for bigger market participants, bigger players in the market, especially those trading options, and where do we have a chance to see higher support, respectively resistance, and especially where do we have some squeeze potential. So I, for example, knew, and that's, for example, when looking at the chart right now, so probably after that webinar, just look at your DAX chart. You will see that we had some strong resistance at the region around 13,400 points, for example. And that said, it doesn't come as a surprise when looking at options, because you could see before the expiration. Unfortunately, right now, the numbers are not given anymore because all these options expire today at 1 p.m. German time, so 12 p.m. London. And it was, in fact, it's a triple witching today. So big expiration, not just in regards to futures, but also in regards to options. And so when looking at 13,400, you could see that there was a high interest of market participants not letting the DAX push above that level. That doesn't mean that we have no chance or had no chance to push above that level. It means, in fact, that once the market pushes above that level, that then a certain demand, in case of written calls in this case, will naturally come into the market, because those market participants betting on the market, in this case the DAX, trading below 13,400 points, these market participants have to hedge their exposure. In fact, to some extent they are short already, and then you get to see something which we refer to in trader lingo as so-called short squeeze. The same is also true for the downside, but just to give you an idea how you can use these numbers. So again, it's not the holy grail, but if you combine it, some very, very interesting ideas can arise from that, in fact. So now let's have a look here at the numbers being displayed within the chart. So you can, I use these color here within the indicator I was just referring to at the beginning. So again, if you're interested in the indicator, it's not a standard indicator. It's not none of these indicators you can find within the Admiral Markets Prime or a Supreme edition. I'm sorry, Prime, no, Supreme edition. Feel free to reach out to Admiral directly, and then you can get the Murrey Lines indicator. What I can say is here, for example, we are looking at a dollar CAD chart in this case, and so it depends certainly where these levels are displayed. It depends on the time frame you're using, but in general, you can say it refers to the high and the low, and then within this there is this sequence of eighth being calculated, in fact, and based on that, then these lines will be displayed. So now, this is probably something, yeah, which is a little difficult now, let's say. Oh, I'm sorry. Okay. I'm sorry. I just thought that I have here an indicator, not an indicator, and a URL being displayed, but it's somehow not within the slide. Let me just post it here. So there was already an article on the website from Admiral Markets, an educational, where you can also find some thoughts, not only on Murrey lines or Murrey Math lines, but also on other support and resistance indicators. But Murrey Math is one of these, and you can find them within this article here, in fact. So, and what I did here was, in fact, that I just wrote down what level is what does any level mean? So 8-8 and 0-8, for example, lines. These are under Murrey Math lines to be considered. They are named ultimate S and R, and this is short for support and resist. So this is the strongest support and resist. If you're long enough trading and within the market, you know that a support is as long a support as it's not broken. And there are sometimes occurrences where these support lines, they can be as strong as you think they are broken for whatever reason. So there's a fundamental driver. Ask those traders around the SMB decision and the SMB taking away the pack at 120 on the 15th of January 2015, for example. There's also a very interesting story I can talk about when it came to a professional trader. It wasn't me who was not the professional trader, but the senior, let's call him senior trader, who did this with me, but I had to smile because I would have been a perfect candidate for this too. So when I started trading, I also went through books on technical analysis, for example. One I highly recommend is, for example, Murphy, it's the technical analysis of financial markets. Unfortunately, I only have the German book here. One of the few German trading books, in fact, I have in my library. So usually these are English titles. I think, yeah, it's definitely, it's from Murphy. That's what I can say. So I was pretty sure that the concept being presented within there are set in stone, and there's. If it's said that this is, for example, a support, it's a support. And now the story goes as follows. So there's the senior trader, and then there is his mentee, or so junior trader, let's call him. And he's discussing with the senior trader, and the senior trader is, after the junior trader refers to a certain level as the ultimate support zone, for example, he refers to it as here the market has to stop. That was during a time when computerized trading wasn't that where it had to be developed, let's say. So it was it's a story which is said to have taken place at the beginning of the 1990s, late 1980s or something. As you may have seen, or you might know, there was the pit trading time. Okay, so and then the junior trader referred to a certain level as the ultimate support zone. And the senior trader just smiled, took his phone, called the broker on the floor, and told him, I just want to sell whatever share it might have been, or DAX, whatever. It probably was a share. And he said, I just want to sell 1,000 pieces here. And the market just boom, broke below the support zone. He hung up the phone, smiled at the junior trader and say, you see, at the end of the day, nothing is ultimate in the market. It depends on supply and demand, in fact. So this is just this is why I'm smiling when I'm reading something like ultimate here. But still, when it comes to Murrey Math lines, these levels, 8-8 and 0-8 here, are referred to ultimate support and resistance. So then we have the 7th-8th line. It's weak, stall, and reverse, in fact, what we refer to here. 6-8 and 2-8 lines are referred to as reversal pivots. So we want to, I just want to go through this now and then present you the trading strategy based on which you can then use this knowledge here to formulate an idea how to use Murrey Math lines in your trading. So we just go through these step by step, in fact. So we have the 5-8 line here. That's the top of a trading range. We have 4-8 lines. So we know that this was one of the more important lines. You probably recall that we referred to 8-8, 0-8, and 4-8, so 50% retracement as major support, respectively resistance. And then we have the 3-8 line, the bottom of trading range, and 1-8 line, which is a weak level, and the stop and reverse level then. Okay, so that's it when it comes to the levels here. And now I want to give you step by step some thoughts how to use Murrey Math lines when it comes to a trading strategy and how to use it. And then we want to go through an actual example here from the GBP USD I just presented several minutes earlier. So what we do is, first of all, we have to make sure that we are trading below the 4/8 Murrey line in this case. So 4/8 again is something we refer to as major support, respectively major resistance line. So we make sure in a long example here that we're trading below this major support line in this case. Once the price trades below the 4/8 Murrey line, then it also needs to trade below the second 2/8 Murrey line here in this case. 2/8, that was what we refer to as the so-called reversal pivot. So once we trade below 4/8, we also have to trade below 2/8 then in this case. And once the market reverses from there, so trading below these lines and then trades back here above the 4/8 Murrey line, we enter a long trade with a buy stop order. Okay, and the stop will be placed below the 0/8 Murrey line in this case, so the ultimate support line in this case. So it's a long trade, so we place it here at the bottom of this Murrey line structure, let's call it. And then we have partial take profits on the upside. So we're working with a 50% take profit at the 6/8 Murrey lines, and where we move our stop to a break even, the initial stop loss, which was placed here at 0/8 Murrey line. So 6/8, this is the so-called reversal pivot. We referred to this in the slide before as the reversal pivot. And then we take the take profit on the other 50% at the 8/8 Murrey line in this case. So, and now we want to go here through the chart, and I want to guide you through this. Unfortunately, the slide, this is not so perfect because I hope that these lines here would then appear, but let's just here use this in this case, and then I'll guide you through the single steps in this case. So 1 second, I just have to make sure that I haven't. Okay, so every question seems to be answered, or no question so far at least. So okay, let's have a look here. So what we have here, the blue line is in this case the 4/8 line. Okay, this is the blue one, and what you can see here, unfortunately, this is not so great because let me just do it the following way. 1 second, please. This is not perfect. 1 sec. So because the reason I do that now is because it's so here. So we have to make sure that we trade below that, which is here. This is the case, okay? And then let me just have another look here. It's also something we have to put here. Okay, so now let's use it from here. And hopefully, no, that's not so perfect. 1 sec. Let me just see. There we go. Okay, perfect. So, and now I want to make the picture full picture again. So, okay. So the blue line. Okay, the blue line here, it's a 4/8 line. And as we did before, this is step 1 here. We made sure that we are trading below the 4/8 line, which is the case here, obviously. So we broke below that line in this case, and now the market is not only trading below the 4/8 line, but the second the second point is also given here. We're not just breaking below that level, but we are now also breaking below the 2/8 Murrey line in this case, given here by the red line. Okay, so in blue we have the 4/8, and we have the red one, we have the 2/8 respectively. Also the here on the upside, you can see it there, it's the 6/8. It's not so perfect because the market was trading here at this current level, so you can't really see the red line, but there's the 6/8 level. Okay, but we're looking at the long example, not the short example. You can only you can, by the way, reverse everything what's said here. So if you're trading above 4/8, for example, and then above 2/8, we can enter a short trade given the same logic here, but now we're looking at the long side. Okay, so we're trading below that level, and we are also trading below 2/8 level. And now what we do is, with breaking back above the blue line here, we enter a long trade. So the long trade is our region where we place our buy stop in this case. So this is 0.3, and there is where we enter long within this candle here. Okay. So, and now we place the stop here as given on this strategy. We place our stop below the 0.8 Murrey line in this case. So 0.8 is in this case here. This is this turquoise line. So here is 0.8. And here is 8.8, by the way. So you can see the numbers are. It's not that it's very difficult to understand the effect, because 2.8 and 6.8. 0.8 and 8.8, for example, all have the same color in this case. So the turquoise line is the 0.8 line in this long example, which means we place our stop here below that level then. Or we can also place it right on this level, but I place it slightly below, so make sure that you can still see the turquoise line in this case. Okay, and then we enter the long trade here, and once the market then moves in our direction, the first take profit level we have here at the 6.8 level. So this is the other red line in this case. So we take 50% of our profit, and unfortunately, I have to say that you can see I've taken the the chart here, but what I can say is that there's a high likelihood now when looking at GBP/USD, you can see that we had a good chance that we also reached our take profit level, given the bullish action we've seen in pound sterling over the last weeks, in fact. So this is where we take 50% of our profit. And once this happens, we also trail our stop from this level to the break-even point here, to the 4.8 level, so our entry price. And then the next 50% is one hand it's reached, or market reverses from here, and then we stopped out on 50% of the position on break even here at this level. In fact, yeah, and this is a concept which is Murrey Math lines based, in fact, and then how you could formulate, given these pivot points. Given these pivot points here, a strategy, an idea how to use it in your trading. And so yeah, I probably think this is probably the best time to ask now whether there's some questions. Is there a question? Something? Okay, so Baram asked, why do you set 8.8 and 0.8 at these levels here? So the question you have is, where do the 8.8 and 0.8 comes from? Because what we do is here in this case, so we're looking at a daily chart in this case. So what it does, in fact, is it uses the high and the low of this period in this case. So let me just again see. So it's here. This is the first high, as you can see. Unfortunately, this is difficult to explain right now, because it depends on the parameters you use here in this case. So you can use it in every time frame, and here within this time span, it seems quite obvious, in fact, that the high and the low is not displayed right here. So this is, in fact, the standard indication for the Murrey Math lines. Let me just see. I think the standard indication was something like 1,000 days or so, if I'm not mistaken. Let me just see. Let me just check this. One sec. It's I think the standard, yeah, so the period in this case was 1,440, step back is 0, and the P is 64. So this is the default, I think, or the standard parameters you put into this indicator here in this case. So, and this is how you get 8.8 respectively 0.8 in this case, and then based on that, then you start to divide the eighth based on that. So in Germany we call this equidistant. It's like there's an equivalent distance between here every of these 8 lines in this case, given the fact that we use the whole interval and then we put in 8 or we divide it by 8, in fact, and so you get the equivalent distance. Okay, so is there any other question? Any other question? Let me just see. Okay, yeah, lovely hat. Yes, yeah. I just hope you enjoy that. I have another one, which is I used it in a morning meeting, which I run for my own company, and so I had a webinar in the morning in German, and there was my hat was playing Merry Christmas, in fact. So, but I thought that's probably not such a good idea because it takes something like a minute or so till this show ends, and probably we don't have the time here, in fact, for this yeah, for this Merry Christmas show or whatever. Yeah. Okay. Yeah. This is really nice that Vincenzo's what he's writing here. So I didn't know about the existence of mirror lines. I can tell you the following. Let me just see. Probably we can do the following, so that you can also see that this is one way of putting support and resistance lines within your charts. So based on this concept, there's several other concepts, and again, it depends on which trading type you are, on who you are. So hopefully the website opens now. So here, this is the article I just posted. So it's support and resistance indicators, and you can see it here. Reading time is 23 minutes, so it's a quite long piece, let's say. And what you can see is that there are several ways of how to find special support and resistance zones within your chart. So Murrey Math is one way, but there's also, as you can see here, classic Fibonacci support and resistance. So which means you define a high and a low, and oh, this is not so cool because, yeah, but you can see it here. So you have the high, which is defined here. I can't even read which currency pair it is, but the concept stays the same. So you can put a line here, or you can draw a line between the high and the low, and then based on that, Fibonacci levels are displayed within your chart. So right here, you can see that's not only the classic 50% and 61.8% respectively, the 38.2, but there's also the, let me just think, I think it's 30, I think it's 28, I think it's 28. No, it's not 28. 1 second. It's 23. 23.2 and 78.2. 78.6. Well, the funny thing is, you can already guess that's not the levels I display, because the highest relevance and Fibonacci's when I display them is 50% and 61.8, respectively 38.2%. 61.8 is a level I consider to be a deep corrective level, while 38.2, for example, is a level, a corrective level, which I interpret in my trading as a strong trend being given, and the market dynamically is strongly trending in direction of the current momentum. So this is how you could use, for example, Fibonacci's in this case. Then you have also wolf waves. It's an also quite interesting concept. The thing is that wolf waves in my trading do not play such a big role. I experimented a little with them, and I found out that I'm just not very, how can I say that? I just don't work very well, or correspond not really good with such patterns here. And wolf waves, they follow a concept which is very similar, in my opinion, to Gartley, respectively butterfly patterns and all this. It's also a way to find potential target lines within the chart. And all it comes down, this is something probably which is very important. Again, it depends on your personal trading style, on your personality. What I like to say is, in my opinion, there's no good and no bad, but it's all coming down to you personally. What these levels have to make sure is that you can easily understand or easily spot whether a trade you plan to enter, especially discretionary trades here, whether they deliver positive or good risk-reward ratios within your trading. So usually you should aim for a higher target than your initial risk is placed. So for example, if you're risking, let's say, 50 euros, you should go for a profit which is bigger than 50 euros in my trading, for example, but this is mainly quantitative based. But I have a payoff ratio of currently, at least the current market conditions are not very favorable for my strategies I'm running. It's the breakout strategies, respectively trend following strategies, and especially breakout strategies. Currently, you can see it within the market, and currently volatility coming down. You can see that this is not very favorable for breakout strategies. But what I can say is that my payoff ratio, so the average gain to average loser, is something between 1.2 to 1.25 to 1, which makes it necessary that I have a hit rate which is around 50% to trade profitably. So I have a positive expected value. But when it comes down to support and resistance, then it's something which is also important to recognize. If there's a high significance of these support and resistance lines, it can give you a good idea of whether to enter the trade from a discretionary perspective or not, based on the question. So if 1R is something like, let's say, 50 euros, but the next potential line of, in case of a long trade, strong resistance comes in already at, let's say, something like 1. Let's say your next target is 1R away, so the take profit level is in the same distance of your initial risk. It means nothing more than, if you can't sustainably trade with a hit rate of higher than 50% within your trading, you shouldn't take the trade, because the hit rate of 50%, this is before commissions, before spread and everything. If you're trading break even, that's definitely not a very good way to start your trade down here. But you have to have, right from the start, a positive expectancy with your trade. And support and resistance lines like Murrey Math, like pivot points, like Fibonacci's, they can help you finding them. Again, the thing is, and this is something which critics usually say, they're to some extent self-fulfilling, which means it's not necessarily given that the market really considers these levels to be relevant. So let me tell you another story. So when I was a trading assistant at a stockbroker I was working for as a professional trader, and I already told you that I was reading through several trading books, technical analysis and everything. I really wanted to grasp the concept behind this, and I wanted to study hard to show that that I'm a good trader to my employer in this case, sure. And the thing was that I thought that technical analysis is so important to realize that. At the end of the day, it's only one way to analyze the markets, but back then I thought this is where all the professional traders get their informations from. And so we were discussing about the current situation in the DAX back then. And I was looking at the chart, and I very well remember the situation as it has been yesterday. So I looked at the chart, and I saw an inverse head shoulder, and I was then it was my turn, and then was the question, hey Jens, what do you think about the market? Even I was only a trading assistant, still there was some interest in my thoughts, and I was start to explain why I think that the DAX will take off from here because of this inverse head shoulder. And my senior trader listened to me and then smiled. It was she smiled and said, and can you please tell me again, what exactly is that? It's an inverse head shoulder. So I think every retail trader knows inverse head shoulder formations, right? It was a senior trader. She was trading for over 20 years, and she traded with amounts of money not many of us have yet seen. So 7-8 figure amounts, and was making tons of money, made already tons of money, and still makes, I think. And she never heard about this. She never heard about head shoulder formations. For her, it was like, okay, it's nice that you say that. And she tapped me on the back and said, okay, so it's 3 p.m. So in German time, 3 p.m., 3:30 is the time when U.S. markets open. So do you want a coffee? So it's on me today, and then prepare for U.S. markets. Will be a more volatile trading session today. And she smiled, turned around, and went to the to bring the coffee. Then, so why do I say that? It's and this is why I refer to clusters in this case. So you have to make sure that you're not the only one seeing that, because this is making things very, very difficult. So even if one indicator provided some trading signals which have been profitable for the last, let's say, 2 weeks, that doesn't mean nothing, especially if you're having a quite high trading frequency with more than 1-2 trades a day. So you need to make sure that it's not only one indicator, but probably 2-3 indicators providing you with these support and resistance lines, because this gives you a cluster and the level to be of a higher significance in this case. Yeah, and that's there's a small story around this. And again, so we don't want to go through the whole article here, but you can already see it here. Camarilla pivots, for example, something I referred to. And then at the end, and that's probably also one of the reasons why Vincenzo hasn't heard about it yet, Murrey Math lines are not that common, but still a very, very interesting concept to have a deeper look at, in fact. And yeah, so let's come back, because I just looked at the time, and then I think we're running out of it. So let's sum everything up here. So Murrey Math is based on observations being made by Mr. Gann in the first half of the 20th century, a mathematician, based on geometry. And Murrey Math divides prices similar to Gann into 1/8 intervals, delivering zones of support and resistance. And then Murrey Math geometry is quite simple, which is also something which I highly recommend. So don't overcomplicate things here in your trading in general. And Murrey Math is one of the concepts which are very, very interesting also for me, because of the fact that Murrey Math is a very, very simple concept. So you have a high, you have a low, and then you divide the chart in 8, and that's it, in fact. And with the presented strategy, a basic concept here, a potential automated fractal trading system could be created, could be formulated, which is based on clear, clean trading rules, in fact. Definitely not. So I can. This is a question I just received here. So Baram asks, one basic important question: isn't having insight to an order book, market profile absolutely mandatory for successful trading in any strategy? So I'm not sure how it is currently in the English-speaking world, but in Germany we have currently a real run on a market profile. Everyone is going crazy about this, and everyone wants to know, and not only to know whether it's mandatory to have it and to be successful in your trading, but everyone is going crazy about finding ways to get insights into the order book, market depth, and everything, market profile. So what I can say, unfortunately, I forgot the name. Oh, shame on me. This is really, because it's a classic. I forgot the name. Let me just think about this, and then I post it in the chat box. But there was one book which was published in the 1980s already on market profile, which is, I don't even know whether it's still available. Probably it's only available in PDF format and somewhere in the internet, and you have to buy it, or you can get it for free. I don't know. But what I can say is that market profile has been around for quite a while now, and only because everyone is talking about it doesn't necessarily mean that it's the holy grail. Then sure, it's great to know what bigger market participants do, but all in all, it comes down to trade with a positive expected value. And what I can say, also based on personal discussions with other traders, is that simplicity in trading is key to long-term success, because it's easily to follow, or it's easy to follow, it's duplicable, and it's easy to follow a clear set of rules here in your trading, which is mandatory for successful, profitable trading in the long run. And that said, if you can work with market profile, and if you can gain an edge with that, go for it. It's definitely worth it, and there's no reason not to look at it. But I assure you, there are plenty of traders out there not looking at market profile at all, trading discretionary and very short term probably also, and still are very, very successful. And don't really want to overload their chart with market profile and an order book and everything. Sure, some traders do that, and I also know one which is highly successful, especially here in Germany. But I can also tell you that it's very, very difficult for others to follow him. Respectively, he is not giving any seminars or something, but he says it's very difficult for me to give others my thoughts on the market. Not that he can't talk about the markets or explain it, but first of all, many people just do not understand what he's doing, and on top of that, he's not very interested in giving away his secrets, because there's only a small edge he has within shares as a pure equity trader within shares, and he's an order book scalper, and once he, to some extent, teaches this concept to others, his edge would not only diminish but probably turn unprofitable, and there's no real reason for him to do that. And so yes, that's what I have to say about that. So it's definitely not mandatory. If you gain an edge with that, great, go with it. I highly motivate you to do so, but still, I don't really think, based on my personal experience over the years, that this is necessary to be successful in your trading. Yeah, so we have a Christmas break. So here again, my hat. Respectively, Marcus, Paul, and I, we are taking the week from December 21st till the 6th of January. We take off. Respectively, we return. Paul returns on the 6th of January here, and that will be Monday, the 6th of January, with him talking about trading discipline, including ensure your trading is always on point when it comes to discipline. Be aware of easy discipline mistakes to make, and share a daily trading tactic to practice and build your exercise. And here also, to some extent, you can already see it. The easier your trading approach, the easier it is to follow clear rules and the system which has a positive expectancy, and take it then from there. And yeah, it's Monday, the 6th of January 2020, 2 p.m. GMT. Check your inbox for the webinar link. Everyone who joined the webinar here will definitely get one, because you registered already. If not, if you watch this video here on YouTube, then go to admiralmarkets.com, and there to the education tab, webinars, and then register under Trading Spotlight. This, I think, if I'm not mistaken, but I think it's only the email address you need to give here, and then you're registered. And let me. Oh, that wasn't. Again, sorry, that was my mistake. Not clicking the link. That's probably a good one. So, admiralmarkets.com. This is where you find further information, and I already said it at the beginning. Admiral is a fully regulated broker. That's why we have the risk disclaimer at the last slide. Here, please feel free to send an email for the Murrey Math line indicator if you want to have it. And that's it from my end. So Merry Christmas, Happy New Year to you all, and talk to you again then in my case, on the 10th of January. Paul will return on the 6th already on Monday. All the best. See you. Talk to you soon.